Welcome to Rethinking the Dollar. Today I'm excited to have my guest, Mr. Michael Pento, president and founder of Pento Portfolio Strategies and the author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael is a well-known and successful money manager and has been a regular guest on several business broadcasts such as CNBC, Bloomberg, and Fox News Business. Today he joins us to share his thoughts on the global economy as well as fiat currencies, especially information surrounding the dollar. So, Michael Pento, welcome to Rethinking the Dollar.
Thanks for having me on, Mike.
Well, I appreciate you taking time. I followed your work, so I'm more than aware of who you are. But the goal is to reach out to those who may not be familiar with Michael Pento and get your thoughts on what's going on and give us some solutions to the problems we face with our economy. So before I actually dive into that, I'll start off with some Rethinking the Dollar questions. And the first question is, what comes to mind when Michael Pento hears the words Rethinking the Dollar?
Well, what pops into my head is that fiat currencies as a whole are becoming extinct. You think about rethinking the dollar. When you say that, does that mean I have to think about the yen? Or does that mean I have to think about the euro? Or maybe the British pound? No, not really. When I hear rethinking the dollar, I hear let's get away from fiat currencies. That is, currencies that can be created out of thin air and by decree. And let's get to a currency, I don't care what you call it, let's get to a currency that's backed by gold and or silver. So it has real value. And why, you have to ask yourself, Mike, well, why gold and silver? Well, let's just say gold. Well, the mine supply of gold is about 1%, increases about 1% each year. And if you look at the increase in the U.S. population, it's about the same. So the basic tenet is that you want to increase the money supply about the same or commensurate with the population growth and a little bit of productivity growth. So you can't do that with fiat currencies. For example, if you look at central banks today, the ECB, the Bank of Japan, and our Federal Reserve, they're printing money at the rate of about $200 billion worth of confetti, of counterfeit money, of paper money that is backed by nothing every month, each and every month. That's the pace. So we don't really want that. We want something that's backed by gold and or silver. And that's what I hear when I hear you say, rethink the dollar.
Fair enough. Now, next question, the idea of, getting people to understand what I call monetary awareness or monetary literacy has to do with understanding the basics of Austrian economics, as you mentioned earlier on, as well as just understanding some practical things for your personal finances. So right now, with everything that's going on, why is this subject matter probably the most important for everyone to begin paying attention to right now at this particular time in history, do you think?
Well, I think about what President Trump has espoused as far as the debt ceiling. And we used to have something in this country called the debt ceiling, and used to be embraced by most people because it was the smoke alarm. It was the fire alarm. It was the emergency brake, which said, hey, we as a nation have borrowed and spent too much, and we have reached the upper band. We have reached the limit. And that is, going extinct as well. So when I hear Austrian economics, I hear about balanced budget and I hear about sound money. And those things are becoming, as I say, very, very rare and extinct very quickly.
Right. Now, if I was to ask you, we're approaching the end of the year. And so what are some things that either have you worried or have you excited about the markets and where this country's heading and where our macro economy is at this current point?
Well, I mean, not much has me excited, but a hell of a lot has me worried. If you look at metrics that measure how expensive the stock market is, if you look at things like price to sale ratios or total market cap, the total value of stocks as a relation to the economy, we're pretty much at all-time record highs and way above the long-time averages for these ratios. So I'm very much concerned that all of the bubbles that we've created, we had a huge bubble in 2008 leading up to the Great Recession and the credit crisis. That bubble was in real estate. And that bubble popped. That brought down the entire global economy with it. Well, now we have a bubble in everything. If you look at home prices in relation to incomes, their home prices are at a record high and far outstripping the pace of even nominal incomes. And as I mentioned, stock prices are at all-time record highs and much higher than income growth, much higher than the GDP of the economy. And if you look at the biggest bubble of all, Mike, it's in the bond market. You know, we have some 25% of the developed world's sovereign debt with a negative yield. So basically, governments are getting paid to borrow money. And anybody can understand that that should be antithetical and anathema to anybody. Why should I get paid to borrow money? But about 50% or half of the world's developed sovereign debt is trading below 1%. So it's an epic, gigantic bubble in bonds. I wrote a book about it, as you mentioned when you introduced me, and I wrote that book back in 2012. I never imagined we'd have negative interest rates, but they're pervasive across the globe. That bubble is about to burst. I think it is in the incipient stages of bursting. And when that bursts, it's going to bring down all of the asset bubbles extant in the global economy today.
Right. Now, speaking of negative, you know, most of those nations you're referring to are in the EU. And so my question a while back was, do you ever see actual real negative rates? And Japan. Do you ever see real negative rates coming here to the United States of America?
Nominal negative rates? Yes, I do. I think there's a push among global elites to eliminate cash from the system. And you cannot really have negative interest rates, profoundly negative interest rates, unless you eliminate cash. So, for example, if I put my money, if I have $1,000 in the bank and the bank tells me that I'm going to have a negative interest rate of 10% per annum, well, I don't want to lose any money. I'm going to take my money out of the banking system completely. So if you maybe have a negative interest rate of 1%, maybe you'll tolerate it. But if interest rates go 10, 20, 30%, 50% negative interest rates per annum, well, I mean, if I put $1,000 in the bank at negative 50%, I'm left with $500 per year. So what they do is they eliminate cash. We have a totally digitally based currency system. So you cannot take your money out of the bank. It's either in the bank or you can spend it. And if that happens, interest rates can be anything that they want because you have no choice. So nominal interest rates could be negative. Of course, we have real interest rates, which is the nominal rate minus inflation. Real interest rates are negative pretty much across the globe. But your question was, can we have nominal negative rates here in the United States? I say yes. That's probably going to happen after the Great Recession.
The greater recession?
The Greater Depression.
The Greater Depression.
I'm going to call it part two, which I think is going to occur once central banks get out of the currency printing game. Mm-hmm. And that's going to happen later on in 2018. And in response to that, we're going to have negative nominal rates and helicopter money.
Helicopter money. Okay, now before we get to that concept of helicopter money, you hinted at, Greater Depression or Greater Recession, but, according to mainstream media, we're in an economic recovery. And so how can we be heading towards a Greater Depression when our economy is so good, according to mainstream media?
Well, if you can borrow money for virtually nothing around the world, and you can take that money and buy stocks and bonds and make the richest top tier of the United States or even around the world richer, and the middle class, you eviscerate them. You totally hollow out the middle class. It looks good for the global elites and it looks great for the very rich, but it's not very good for the middle class or the poor. That's why you see this trenchant and widening gap between the very rich and the very poor. It's the fault of central banks. It's because they're creating asset bubbles by creating money. And the way they create money, so is they create money out of nothing. They print electronically derived credits, and they go to the primary dealers, which is the biggest banks on Wall Street, and they buy their assets, which are stocks and bonds, mostly bonds in the United States, but they buy stocks in Japan and in Europe, and corporate bonds in Europe too. And they take that, the banks, the primary dealers, take that money, that new money, and they buy more stocks and bonds, making the rich richer and richer. And the middle class, the people who don't own real estate, the people who don't own a lot of equity exposure, they get poorer and poorer because their real incomes don't budge.
All right. You hinted at another topic, helicopter money. That's a term that I think I've heard you mention several times. And so do you think that's kind of related somewhat to the whole idea of it being mentioned of a universal basic income as a tool, as a monetary tool come down the line? What are your thoughts on that?
I have so many thoughts. I can never cover them in this short interview. But the idea of giving people money so they could stay home and do nothing is completely anathema to capitalism and a productive society. But it's come. I believe it is coming. Of course, you don't see any hints of it now unless you study this on a daily basis as I do. You look around and you say, well, my house is going up in value and my portfolio is going up in value. So what is Mr. Pento really talking about? What I'm talking about is the fact that central banks across the globe have printed $2 trillion this year alone of that counterfeit confetti that I mentioned before, called quantitative easing. And that has sent these prices of stocks, bonds, and real estate through the roof. And if you look at October, around October of 2018, 1 year from now, the European Central Bank will be out of QE, and the Federal Reserve will be selling $60 billion worth of treasuries per month. So what am I saying? I'm saying that in a year's time from now, much, if not all of this quantitative easing goes away, and asset prices will be having to live and exist under their own strength. And there isn't a healthy economy, a vibrant economy to support these asset prices. So they are going to come crashing down. And when that happens, we're going to get negative rates in nominal terms and helicopter money. And just to describe exactly what that is, I'll define that for you. It isn't just printing money and giving it to the banks. It's directly sending money, circumventing the banking system. So the central bank will be sending checks directly to you as an individual. Yeah. And that's what I think is coming. And that's when you'll see inflation become intractable. You'll have hyperinflation probably around the globe. And then you'll be rethinking the dollar very, very soundly, because you'll say, hey, I can no longer support having a dollar that's not backed by gold. I need to have a currency that I can believe in. And that's the basis of a capitalist society. You need to have faith in the currency's purchasing power. And that will be blown away after the next depression, which I think could be as soon as a year away.
As soon as a year away. Wow. Now, you hinted at, inflation. And so, a lot of people who hear this, who may not be aware of how, the economy works and how money in and of itself comes into existence, will say, hey, I would love to have a free check sent to me every month. I mean, unaware of the fact that it's very inflationary. Now, once this Greater Depression comes and they start, quantitative easing times, whatever number, and so the monetary base expands, do you see a such thing as hyperinflation, to where there become some real problems, where people become, aware of how bad this UBI, helicopter money, things like that will be? Will it be felt immediately, or would it take some time, is my question.
Well, you mentioned universal basic income, and that's basically sending checks to people who aren't productive. And when the money supply outstrips the productive populace and outstrips economic growth, so you have, what is economic growth? It's basically population growth, or growth in the labor force, plus productivity. And if money supply is growing much faster than either of those conditions, because I'm paying people to stay home, so they're not in the labor force, and I'm paying people to be unproductive. So you're going to have no GDP growth, or very little GDP growth, and you're going to have a massive increase in not just base money, which is what the central banks create, it's base money, or Fed credit. You're going to have broader aggregates. So you're going to have actual physical currency. So M1, M2, and M3, larger monetary aggregates, will be growing much faster than GDP. So you could very well have hyperinflation. Absolutely. That's where I think, unfortunately, we're headed, because I just want to mention this. In the last recession, the Great Recession, circa 2008, the Fed funds rate, which is that all-important key interest rate, was 5.25%. And at that time, Ben Bernanke was able to lower that interest rate to 0 and start quantitative easing. Well, this time around, when the Greater Depression, or the Great Recession Part 2 hits, that key interest rate might be maybe 1.5%. So there isn't that room to lower the interest rate. And we already have had 3 iterations of quantitative easing, or money printing. So the next round that's met by, let's just say, do a thought experiment. Let's say we enter into the Greater Depression at the end of 2018, and the Fed can only cut rates by 150 basis points, or 1.5%. And then they start printing money. They don't go to negative interest rates, or they go to helicopter money. There will be no faith left in paper currencies. It'll be destroyed. A huge chunk of that faith was destroyed in 2008. But the belief was that we can print and borrow our ways out of this. But when that's proven wrong in 2018, if I'm correct, 2018, maybe 2019, but I think it's 2018. When that's proven wrong, faith in fiat paper currencies will evaporate very, very quickly.
Right. Now, I want to share something with you. Yesterday I posed a question via social media, and I shared this, if you can see it, I shared this graph here. And I mentioned that if this was a stock of a 100-year-old company, would you buy or sell? So my question to you is, you know how
purchasing power? Is it the purchasing power?
Yep,
of the dollar?
it's the purchasing power of the dollar. I'll put it up again so you can see it. And so what happens when this graph goes below zero? Is this the hyperinflation you're talking about? If you know, just work with me there. Is it if it goes below zero?
Well, here's what's happened. So, in hyperinflation economies, if you look at Weimar Germany or Zimbabwe or the Hungarian Pento, Argentina, if you look at these hyperinflation economies, what did they have in common is that they were in isolation. So following World War I, Weimar Germany had to print a lot of money to pay their debts back. But they didn't do it because there wasn't any euro. I mean, all these European countries had their own currency, and the U.S. dollar was separate and the Japanese yen was separate. So when you have all of these developed world economies printing in unison concurrently, it's very hard to have this hyperinflation. Mm-hmm. But as I said before, the next recession comes, even though they're all printing, the faith in paper currencies will be eviscerated, and that's what's going to cause hyperinflation. So as of now, it hasn't occurred because, like I think I started the program, if the Fed is printing money, but so is the Bank of Japan, they're printing money like crazy over there, and the ECB right now is printing 60 billion euros a month. Well, my dollar really is not going to lose value against the yen or the euro or even the British pound. But when they're all doing it together in unison, and they do it helicopter money, and they have negative interest rates, the middle class of all of the world will eschew these currencies on moral grounds. They will understand that maybe they're not losing their value against the yen or the euro. Maybe the dollar's holding its value against these other currencies. But against hard assets, the dollar's value will be getting crushed. Its purchasing power will go close to zero. It can never really go below zero. But it can go to zero. Or very close to it. Right. So, you asked me, where are we going to have hyperinflation? If I'm correct, and the next depression occurs, when there is no real bullets left for the Fed, except for those two things, helicopter money and negative nominal rates, then yes, you will have hyperinflation across the globe, concurrently, pervasively, against all hard assets, especially gold.
Especially gold. Now, okay, so that's a realistic picture that I can see and understand based upon how things have worked over the past. Now you have those watching who are, expecting pensions, they're expecting Social Security, they're expecting all these conventional financial vehicles that they've been told are guaranteed or coming, or it's just following the mainstream narrative of investing. So what happened to all these people? They're going to lose everything. So give us some solutions now. Like, how can we? You mentioned gold, silver, but yet what are some steps that the lower class people who have low minimum income, how can they be proactive? How can the middle class, as you mentioned, and then how can those who are well off, kind of protect or hedge or whatever you like to call it?
Well, if you have any investable assets, you should have a dynamic portfolio manager, because the buy and hold theory of investing doesn't work anymore, Mike. Mm-hmm. Maybe it worked from 2009 till today, but I assure you, if you bought stocks in 1999 and you waited 10 years after that, you would have been completely destroyed. And if you bought stocks today, if you're a first-time investor today thinking you could, I heard Warren Buffett on the television today saying, hey, just buy and hold, you'll be fine. That might have worked maybe in the 50s or the 60s. But when we went to a total fiat regime in 1971, everything changed. So there has never been a time like this in the history of global economics. We have never printed in the United States, increased the Fed's balance sheet by $3.8 trillion in a very short period of time, or at any period of time. We have never before taken the Fed funds rate, that key overnight interbank lending rate to 0 and left it there for 9 years. We have never had the European Central Bank with nominal negative nominal rates. We have never had the Bank of Japan print money like it's going out of style. And the same thing can be said for the Bank of England and China. So we have never had this situation before. So you have to have a dynamic portfolio investor that could hopefully, which I'm doing here in my model portfolio, safely making money until the collapse occurs. And then when the collapse starts, being able and having the ability to short the market. I want to remind your audience that in 2000, the NASDAQ lost 85%. In 2008, the S&P lost 50%. This next time around, before the central bank's ascent to helicopter money and negative nominal rates, markets could lose 80% of their value. It's not out of the question. It's happened before. And given the lofty levels that they're starting from, it could happen again. So have a dynamic portfolio investor in place for those who are very rich.
Well,
for the very poor,
I'm sorry. Go ahead. No, for the very poor. Go ahead.
For the very poorest among us, I could say don't have a lot of debt. I hear a lot of people saying that, but in hyperinflation, you want to have a lot of debt. So I mean, I guess I would say pay down your investments now, get out of debt now. And then once the inflation starts, take on as much debt as you possibly can, because you're going to be paying it back in a fiat currency that's almost completely worthless.
Right. Now, I heard, I believe that could be true, but then I also heard the opposite on this last point before I let you go, that, it'll just be whatever after the collapse and depression, whatever happens, there'll be a new adjustment of some type of monetary structure, and it'll just be readjusted in nominal figures to kind of, equate to the same type of payment that you were making before, being that this is all about saving the commercial banks, the globally too big to fail banks, so they're not going to lose out in one way or another. So what are your thoughts on that?
They have to lose out. I mean, you say the banks are owed all this money from pension funds and from the shadow banking system. I mean, these people that owe this money have no funds. You look at the pension system today. There is no funds available to pay back the public unions and the private unions. I'm talking about Social Security, Medicare, Medicaid, fire, police, teachers. There is no money available unless they hyperinflate the currency. So there is no escape. There is no reset. They can't just say, okay, well, I owed you 100 million. I owe you, for example, I'll give you some numbers. Globally, the debt has increased $70 trillion since 2008. $70 trillion. That's 230 trillion in total, 320% of global GDP. So there isn't any, the global economy isn't spinning enough capital to even service this debt. Forget about paying it back. So there's going to be massive defaults, and when you default on this money, banks go out of business. So there is no easy way out of this. We're going to have chaos like we've never seen before in the history of economics across the globe. And I wish there was an easy answer, like just revaluating the currency. But that just doesn't exist. So I mean, you can convert your currency like they did the Hungarian Pango or the German Deutschmark to mark. But there's a lot of pain along the way, and that is unavoidable.
A lot of pain along the way. Well, Michael Pento, I thank you for sitting down with us to share your thoughts on what's happening. Can you give those who may not be familiar with the work, where can they find you? How can they find your book? And how can they stay in tune and be a blessing to what you're doing?
So the website is pentoport.com. I have a weekly podcast called the Midweek Reality Check. You go on the website, and it's $49 a year. For that, there's a free trial, though please come to the website and subscribe for a free trial. Or email directly if you have any questions at mpento@pentoport.com. And the office number here is 732-772-9500. Thank you very much for having me on today, Mike.
Well, I appreciate it. Look forward to continue to follow your work and hopefully have you on, say, next year or a couple months from now when things unwind some more and get your take then. So thanks for sitting down with us.
God bless you.